How should investors navigate the current market? Joining me now, we've got Larry Sprung, who's the founder of Mitlin Financial and author of Financial Planning Made Personal. Larry, good to have you back on the program. How are you advising people near retirement right now to evaluate some of the volatility that we've been tracking tied to policy coming out of the White House?
Yeah, great to see you, Brad. And I think first and foremost is you don't panic. Volatility is the price that we pay for investing. It's as easy as that. But the important thing here is to make sure that you're level setting, checking your plan, and making sure that the plan still works even in a protracted downturn. You know, make sure that you're on track to reach those goals, review that current allocation, and I think just as important as those with regard to your plan is make sure that you have an emergency fund. Although we don't think recession is on the way, be prepared just in case that you have some extra cash set aside for those emergencies should they arise.
So what about those that are earlier on in their investment timeline and further away perhaps from retirement?
Great opportunity, right? And these opportunities present themselves not too many times over your lifetime. So it's a great opportunity. Look to perhaps accelerate IRA contributions that you are looking to make this year. Accelerate 401k contributions if you're planning to max out. Maybe add more now and then add less later on to take advantage of this dip. Take advantage of that. Make sure your plan is on track. And if you don't have a plan, get one. And similarly, in case, again, we're not in the camp that recession's coming, but if one were to come, make sure you have that emergency fund in place just in case. It's a good thing to have in all markets.
And so what is the mindset that investors are apt to keep in mind, even as they're considering what their time horizon across any age might look like?
Yeah, so I think the interesting thing is, and we forget in times like this, what really actually takes place. Going back to 1990, the S&P has averaged 9.8%. And if you miss the 10 best days, typically there are 10 days across the year that make up the lion's share of the returns for the year. If you miss those, then your return goes down by about 12.5% into the negative. So the whole idea is to maintain your investment philosophy, make sure that it keeps you on track. And remember, some of the best days we see in the markets happen to be clustered right around the worst days. So, we might have some of our best days of 2025 coming here shortly.
Now, what if you just retired? I was speaking with someone just at the beginning of the week, actually over the weekend, about them just commencing their retirement after 36 years working at NASA. And say you've built up that nest egg, you had that retirement and the savings, especially with your investments that you were looking to kind of draw from. What now?
Yeah. So two things I have to say to that is you should plan for that in advance. One thing we do with the families we serve is we run a, bear market test, meaning we run a scenario that if the market were to decline similarly to what happened in 08-09, when it was arguably, one of the worst markets of all time, how would that have affected your retirement if those 2 years, followed your retirement date, which is exactly the scenario you're talking about. And we run it through those scenarios to make sure they're sufficient. If you're in the midst of that, remember, this too shall pass. And the reality is that although you retired now, the reality is that that money is going to have to last you for a very long time, most cases 10, 20, 30 years. So you still have a little bit of a longer term time horizon, and make sure that you have some money positioned for short term, some medium term, and some longer term, so it's not as volatile as having all your assets long term, if that makes sense.
Larry, good to see you. Thanks so much for joining us again.
Thank you.